managing partner at Stellar Insolvency and Advisory, a veteran in the industry, having an year experience of more than 25 years in banking, regulatory, commercial banks, and in emerging economies, and many disruptive ideas that saw commercialization. His biggest recognition was creation of India's domestic payment system, RuPay, mobile wallet, and the introduction of biometrics as financial and social identity for all Indian citizens. Now well known as Aadhaar. I welcome you, Anilji. And then we have Miss Debashri, who works as a senior associate corporate professional, heads the NBFC and FinTech team. I also welcome you, Debashri, to this important webinar. First in our series of discussing topics on related to NBFCs and FinTech. So over the year, if you see, digitization and automation has been forefront of everything we are doing. In our daily life, in our office work, in whatever areas, in government services, everywhere digitization and automation is being extended as a very fast pace. And similar is development we are also taking in the payment and loan space over last 5 years, specifically with the advent of UPI. Most probably, I think there was a game-changing moment in the payment ecosystem. And then with the handy availability of mobiles, development or more speedy availability of broadband, a lot of developments have taken place also on the digital side of the lendings. While companies since long were having NBFCs, banks were having their own application forms on their website where one can do and file. But during the last 3-4 years, with the evaluation of the fintechs in India, where they have actually augmented or helped the existing financial players in completely revamping their processes, how they do lend, by introducing new technologies, new processes where paperless lending is completely possible, credit harassment is possible, entire credit life cycle in terms of receive of query, processing of the credit analysis, processing of application, and disbursement of loan can all take place without even meeting between borrowers and sellers. Though that as part of the P2P peer lending, that also happens where buyer and lender is brought at a common platform. But in last many years, there has been also a invent in terms of new digital lending apps where likes of like Paytm, PhonePe, where these apps, apart from a lot of other payment related services, have also been helping the financial sector in form of banks, NBFCs by partnershiping with them, and then giving them an added platform to lend money apart from their own website. And they introduce technologies where you can do credit analysis by way of the information that they submit, basis the analysis of CIBIL, basis their social profile. Even the KYC can also be done online through a lot of technologies that are available. Aadhaar, PAN, instant verification can be done. So the entire process of the loan processing has been reduced to, in a lot of cases, in just hours or minutes, where it earlier used to take place weeks and months to get a loan processed in India. With the advent of these new high-tech mobile apps and specifically lending apps, the process has been completely revamped, and that has also enabled the borrowers to find credit at a suitable rate, and also helped NBFCs and banks to target to a much larger audience, which they were earlier not being able to, and because of their own weaknesses in their inherent processes, which were removed by the new age apps by introduction of technology. And there are more whenever there is a change, whether there is a technology, there is an advantage and a disadvantage on both sides. Advantages, as I mentioned, were in terms of faster processing of loans, easy availability of credit, accessing to a larger number of borrowers, which was a limitation earlier. But then we also saw a lot of cases related to appearance of fraudulent apps where Chinese were involved, and a lot of frauds were also done with the borrowers. Certain cases of harassment also takes place, which led to some sad cases of suicide. So that was the other side of the app, because this was not such a regulated space to that extent. So while the regulated players were utilizing this space to further develop the organized market, the unregulated players were trying to also create a false market in the system, and trying to take advantage of people who were in need of funds. I think all these things led to RBI forming a working group which gave some suggestions, and finally RBI came out with some guidelines on how it would intend to regulate digital lending. I think because going forward, I see most of the lending do take place only through these apps or through websites, instead of we or I or you going personally interacting with a salesman at a office of an NBFC or a bank. So in order to regulate and ensure that this market is developed in the right sense, which helps both the lender and the borrower, new set of guidelines were introduced, which outlined the detailed obligations in terms of both the lender, the obligations on the platform, how the conduct will be there of the platform and the ultimate lender with the borrower. There were a lot of things that were there, and since this was in developing over the years, there was also a concept of digital lending apps entering into tie-ups with small NBFCs and giving them an opportunity to lend, create market for them, and also entering into some kind of back-to-back arrangements in order to give them some comfort out of the defaults that may arise because they lend on their platform. So some kind of back-to-back arrangements were also entered, where the lending app providers gave some commitments to the lender that in case of any default, you lend through our platform. In case of default on account of the borrower, we will be able to be compensating you on that. Also, that RBI also took note of those arrangements and saw as that something which is not in the right context, and also takes the lot of risk out of the balance sheets of the lender, so which was not in true sense in terms of the regulation. So they have also recently issued guidelines on how these kind of arrangements, where you guarantee give some commitment onto the losses that they can bear in case there is a default on the part of the borrower. So they have also issued a detailed guideline, so that to a large extent also gave relief to both the players, borrower, lender, and the fintech players, that there is given some sort of clarity as to there that it is not something which is completely stopped. Because earlier, when the first recommendation was out, there was there was not such a positive voice on behalf of the regulator that this is something which they want to continue. But when the regulations finally came in, it gave much sigh of relief, though there are inherent challenges in the regulation itself, which I think we'll discuss during the course of the discussion. So I'll move like this. So Debashri will throw a light on the regulatory framework on both digital lending and FLDG. I think Anilji, wherever you feel that you can interrupt, you have some additional point to raise, you can definitely jump in. And then once Debashri is done with, we'll hear your opinion also as to what you think, how the regulations are evolving, and what's the way forward. And there are some questions that we have received. We'll take them at the end of the session. So I'll now request Debashri to take this forward and share her presentation with the participants.
Thank you, sir. Thank you for setting the stage with the introduction of how the digital space has evolved ever since. And also, I would like to welcome from my end Mr. Anil Gupta. He joined at a really short notice, and it's really an honor to have an industry veteran with us today, who has been a part of the entire digital space. I would say he has been not just a an audience, but rather a person who has himself made policies and put things on stage on the track for others to follow. So, so you gave a good introduction. Of course, you shared everything of how the digital lending space has evolved over the period. You also gave a brief of how it has, the challenges that came through, and now how we have reached to today, where there are so many regulations. And there was a time when customers were just running around, and there was no set regulatory framework on which people could fall back. But now with so many regulations coming into place, now I think for at every step, at be it from a lender's perspective or from a borrower's perspective, everything almost more or less is covered under the regulations. So I'll quickly start with the presentation, which will, and I'll take you through the regulatory aspects, which is there on the, which came through the various the DLG guidelines that came last year, and also the FLDG guidelines per se, which came a couple of months ago. Is my screen visible?
Yeah, we can see.
Devashri, you can start. It's visible. You're on mute.
So just to give a brief, maybe Anil sir can throw light on
slideshow.
Yeah.
Yeah, thank you.
Yeah. So I think the background has already been set as to how the digital lending, which is a part of the entire digital payment system, is evolving today, and probably from the after 2010, probably the digital lending is something that came into huge numbers, and it started getting visibility in terms of every bank and every financial institution resorting to some sort of practice, which today we can classify it as a part of digital lending. And various forms of credit, as we can see, there are bank transfers, direct bank transfers, which there are many government schemes, which use this. Then there is scan and pay, which has come. We just take out a mobile and make payment. There's no need to even carry cash nowadays. Then we have, supply chain financing, and n number of different models are emerging day and with every passing day. So today's focus, of course, maybe Anil sir can throw light on the various other forms that are prevalent in the market, and how each form has evolved. So I'll quickly run through the regulation part. Just before that, just to have a small brief understanding of what all parties can we think of when we think of digital lending. So in the middle, of course, we have banks, NBFCs, and financial institutions who are the lenders. Then we have other participants, we can say. Of course, they are not just a part of the digital lending, but they form part of the entire digital, you can say, payment, the entire digital ecosystem, which has very speedily gained prominence. So we have apps, platforms like Bazaar, where we can compare different credits that are available. Then we have Lintra, sort of platforms like Lintra, wherein we can, one can easily use KYC and other related services. Then we have different lenders, of course, NBFCs and banks in the middle. They are the people who are providing us the liquidity, who are providing the liquidity in terms of the credit that is going out. Then it takes various forms of supply chain finance, embedded finance, like Amazon Pay, the payments that go to sites like Flipkart and Amazon. Then there are specific lenders who cater to the MSME segment as well. Then on the other hand, we have entities like credit bureaus, and who store information, help in credit assessment of how much to lend, when to lend. And so these are in a way certain parties who are forming part of the digital lending space. Then moving on, as sir, you earlier mentioned the reason why regulations came. So if we can recollect the first instance in 2016 when demonetization hit, I think very few NBFCs in the country at that time were probably, rather very few who were completely digital at that point of time. So that was the trigger point wherein post that many even small NBFCs today, we can see that they've resorted to digital forms of lending and even collecting the repayments. In industries like microfinance, which is, I would say, the most sought after, the industry which is in most need of the credit at a micro level, and where nano entrepreneurs and micro entrepreneurs are there. They have, although the ticket size being small, but they are the ones who are in much more the the churning of cash happens more in that space, and hence the loan cycle is pretty much smaller, but it's much more the amount being smaller, but the turnaround is much more higher in that space. So in 2016, when demonetization had hit, that was the first instance when all the entities realized that they need to switch to digital forms of, I mean, the physical form would not help, and it affected the operations and top line and the bottom line of all the entities which were there. Then gradually, when pandemic hit, that was another major trigger which you know led to all the institutions switch completely to the digital mode, and there was a rise of, I think, more than 100% in terms of the number of lending apps that flourished during the pandemic. And with that being said, a lot of violations also started coming in. We heard about cases where a borrower who was defaulting, the company would share the personal data to all the people who were there in the phone book of that particular borrower, and and various kinds of harassment cases came out. So that was predominantly the reason wherein RBI jumped in to regulate this particular segment. And because of those violations, a lot of NBFCs were facing the heat, because for RBI, NBFC was the point of was the lender. So the NBFCs were facing the heat in terms of getting penalized in monetary terms, getting their licenses revoked, and the certain activities that they were resorting to these applications were they were charging exorbitant interest rates, breaching the minimum interest rate thresholds that RBI says that it should be justifiable, and it should not bother the it should have a balance of the cost of funds that the lending institution has vis-a-vis the cost that it is further taking from the borrower. So that leverage was also highly misutilized by these lending apps, since they knew that they were just in the background, so they could charge anything at their own whims and fancies. Then there was undue harassment, which we used to take place. Loan recovery processes were completely distorted. They were mis-selling. People used to tie up, NBFCs used to tie up 2-3 different products with their main product and used to make it as a caveat for obtaining the main loan. There were, of course, data breaches and data privacy of the information that was getting stored in those apps. So all these predominantly led to the RBI and the Ministry of Electronics and Information Technology to step in and make the regulations. So RBI predominantly took care of the outsourcing guidelines, which were there even before the pandemic, but it was not. It was just a part of the overall regulations. Digital lending guidelines came in last year. Of course, as mentioned earlier, there was a lot of background behind that. A lot of thought went behind that in terms of the recommendation which the working group gave. Then, with the default lending guidelines, which somewhere restricted the FLDG setup, after a lot of deliberation and industry representations, few months back in the month of June, the DLG guidelines also kicked in formally. And of course, the other operational circulars that keep coming in terms of restricting and setting the code of conduct for the recovery agents, for DSAs, for DMAs, and others. The Ministry of other regulations that we will, if time permits, will quickly touch upon is the Information Technology Act and the Data Protection Bill. These are, these are to be read with the other regulations when it comes to understanding the regulation behind a digital lending setup. So quickly, how the regulations are evolving. So in 2019, the Ombudsman scheme for digital transactions, it was proposed that an Ombudsman scheme would be implemented. Then June 2020, when we were in the middle of the first wave of the pandemic, a circular was issued wherein it was the lending apps were in a way were told to follow the outsourcing guidelines, because these outsourcing guidelines were getting breached in a very were getting misutilized in a very ruthless manner. Then December 2020, RBI sent a specific caution letter to unauthorized digital lending platforms, because by then the number had grown to a very significant level. So RBI could track down these applications. Then further in November 21, the working group was formed. Working group was formed earlier, but it came up with its report wherein it suggested a lot of changes and uh, parameters that should be taken care of while framing the final guidelines. So quickly, if we talk about what is digital lending, of course, if we think about digital lending, there are a lot of things. We have today everything is digital, right from making the payment to receiving a payment to buying anything, moving around anything. We have apps, food delivery apps where we are making payments online. We want to travel somewhere, we have these applications where the money is going online. So somewhere the entire cash circulation, the physical cash circulation has reduced to a lot of extent. And digital lending is something that we can say, even when it comes to lending. So earlier, when the banks, we used to, if we talk about 2000, prior to 2000, wherein there were net banking, even very few people used to use those you know services which are given by banks. But now today, we open the app, anything, we open the app or any other this thing, even while making a payment, we'll get a prompt of click on this and get a loan, click on that and get a loan of so and so amount. So what exactly is digital lending? We'll just quickly touch upon this aspect so that we are able to get a good grasp of how the regulations have been framed accordingly. So digital lending, it says, a remote and automated lending process, largely by use of digital technology. So wherever there is an automated process and a remote process, and these two, and the use of technology is predominant, that is digital lending. Now, these other aspects, these other services that are written, which is disbursement, customer acquisition, loan approval, recovery, these are all these form part of a loan chain, of a of a loan cycle. So any one of it, either if it is, even if one of it is automated and is being used remotely, that transaction will be called digital transaction. Now, the word largely here has been specifically added in the definition, which means to say that if just one aspect, I mean, this helps to quantify whether just using, let's say, only the disbursement part is digital and rest of all the activities are on paper, or let's say only the recovery is digital, just all the activities are on physical. So for, in order to assess that whether the lending transaction is digital or not, the intent behind that needs to be understood in a way that whether that one activity, how significant it is. If it is major, then it will be a digital transaction. If it is just one of a small part of the entire loan chain, then it won't be part of the digital lending process. Just to share a few examples, let's say an application form is being filled in a tablet. We might recollect certain advertisements that used to come years ago, wherein it was shared that a particular bank representative will come to your home and punch in the details, and your loan will get approved instantly. So in a scenario like that, assuming that using of tablet was just one of the incident in the entire loan appraisal system, in the loan disbursement cycle, that just having that one activity in a digital form, because a person is holding a tablet, that cannot be said to be a digital lending transaction, because rest of the other things are all physical. The credit assessment, the uh, disbursement is being done physically, the repayments are being done physically. So in such a case, this won't be a digital transaction. Further, another example, let's say a company, every company has its own websites and collects data of people who are visiting them, even of their existing customers or new customers. Let's say a person goes and fills in the data, punches his own details, and that data is being further used by the company to assess whether that how much loan that customer can take. So that being just a small part of it, even this won't be called as a digital transaction. Further, let's say only credit assessment is being done by program, and rest all other activities are done in physical. Here, credit assessment being the major part, as we can say, because credit assessment determines the loan amount, determines the repayment cycle, determines how much quantum of loan that can be given. It also impacts the interest rate, that the interest rate bracket that the person will fall in, that the borrower will fall in. So somewhere, this being a critical part of the loan appraisal system, if that process is being done digitally, then yes, that transaction can be called as a digital transaction. Moving further, the entities specifically that have been identified in the guidelines. So So it says regulated entities, which are primarily NBFCs, commercial banks, cooperative banks. Now, earlier these DLAs and LSPs were somewhere out of the ambit of RBI, and RBI was finding it difficult to reach out to identify which all apps are there in the market. Because because let's say an RBI reaches out to an NBFC, the NBFC would say that, okay, I have outsourced this particular activity to a particular say loan application, or I have hired this organization to, let's say, do the collections or any particular activity. So these were earlier not completely covered, and there was a need to bring these entities under the ambit of the regulations. That is why these two terms have been specifically identified. One is the DLA, which is the digital lending applications. Then comes the LSPs, which are the loan service providers. Now, loan service provider can in turn also hire a digital lending app, can take the services of a digital lending app. It can have its own digital lending app, or it can outsource the application. It can use outsourced applications. So even in that case, it goes to a second level. First level is the regulated entity, which has its own DLA application. Then the LSP, which the regulated entity is, which has been which has been hired by the regulated entity. Even that LSP further has its own digital lending app. Even that will get covered under these guidelines. Now, what are
Especially
these LSPs?
just a clarity. So when you say only apps, so it means the apps that are in form of a mobile app. Because if there is such kind of a application on the website, I think that would also be covered.
If there is
I think both
it's
the mobile app as well as a web app,
Web
as
app
long as
would be covered.
as long as the
Yes.
interface is either of these two.
Either of these two.
Right.
Okay.
Because the regulations also says that web-based or mobile-based. So even if there is no corresponding application, but there is a website where the data is going in, that will be an application that will be considered under this ambit. Now, the activities earlier somewhere were covered under the outsourcing guidelines, but with these guidelines, with the digital lending regulations, the LSPs have been, the activities that are being undertaken by them has also been clearly defined. So it says that LSPs are agents of the regulated entities who carry out a whole or part of the lender's functions. So let's say there is an LSP which is which is undertaking some activity, but it is not directly related to the activity which an RE can take. So let's say maybe Anil sir, you can give some example wherein an LSP is not associated. In case you have come across any such instance. So it specifically mentions that activities that an RE is supposed to undertake, but it has given it to an LSP. In that case, even if it is just one small activity, it will get covered under the guidelines. And also, as we all know, there were outsourcing guidelines in place earlier, even before these lending guidelines came in, which will guidelines. Earlier, the LSPs were guided only by these outsourcing guidelines, but now with these digital lending guidelines in place, the LSPs will have to fulfill the responsibilities that have been given on them with these guidelines as well. Now, quickly, outsourcing earlier. So this is the digital lending guidelines kicked in. So outsourcing guidelines could be read in 4 different ways, in 4 different avenues. The first one was digital lending platforms, then outsourcing of financial activities, and outsourcing of IT services, and then outsourcing of activities related to credit cards. So quickly, when it came to outsourcing of financial activity, of course, as the master directions of RBI already states that the core functions of the management cannot be outsourced. So there was a clear instruction by RBI to the NBFCs that you can outsource the activities, but the core functions cannot be outsourced. Let's say internal audit cannot be outsourced, which is one of the core functions of any financial institution, and more specifically NBFCs, for which concurrent internal audit is a very good way to keep monitoring the transactions and the overall health of the NBFC. So core management functions could not be outsourced earlier. Then it was stated that there should not be any compromise on account of the outsourcing. Then the customers should not suffer on account of outsourcing activities. And it was also mandated that there should be a robust grievance redressal mechanism for the customers. Then the risks that are arising out of the outsourcing should be clearly identified by the NBFC. Then it was also stated that the direct selling agents and the direct marketing agents, which were being hired by these NBFCs and other banks, other regulated entities, they should be given proper training, and they should adhere to a set code of conduct. So these were certain things when it came to financing of outsourcing of financial activities. In with respect to financing outsourcing of IT services, there were certain guidelines which stated that there were guidelines with regard to cloud compute, with regard to the data that was going into the cloud, then how cloud service management and security controls have to be put in place, disaster recovery, cyber resilience. Then there were of course many NBFCs, they used to outsource all these activities because of the bandwidth. I mean, every NBFC and every small entity did not have the bandwidth to create its own internal strong IT processes. So generally it was being outsourced. So there were guidelines even in that respect. Then for digital lending platforms, this word was earlier used before these digital lending guidelines came in, which is of course very much related to these guidelines which have come in now. And we'll see a lot of comparison when it comes to the earlier outsourcing guidelines versus the current digital lending guidelines. So a couple of things that were earlier in place was that the NBFC has to disclose the name of the digital lending platform which it is using. Then it has to the platform should have the name of the NBFC. I mean, the customer should be aware of the NBFC which is behind the digital lending app. Then sanction letters should be given to the borrower on the letterhead of the NBFC. Loan agreements should be given, because most of these applications, they just had since they were all digitally involved, physical copies were not given. So it was clearly stated that a document from NBFC should come, and customers generally did the fault of accepting the terms and conditions given by these applications, and then they would and then there was nobody behind when there were grievances, and there was nobody to take care of their grievances. And that's when these regulations, the need was felt that a proper document from the NBFC should come. Then of course grievance redressal mechanism, awareness, the applications, these digital lending platforms were given the responsibility of making sure that the customers were aware about the grievance mechanism that they have. Then when it came to credit cards, again, it was said that the outsourcing should not compromise the NBFC's ability to manage the credit. So, the credit appraisal and the decision behind how much to give, what to give, whom to give, these should not be outsourced. These decisions should stay with the regulated entity. Then it was said that random checks and mystery shopping, these things should be done. Now, quickly moving on to the specific pointers which the guidelines give. The first can be understood at the onboarding stage. So it says that the borrower's credit worthiness should be assessed. So these guidelines, so this particular point generally, as we understand, came in because there were a lot of instances which were seen wherein, let's say, an application has captured the data of a customer. Now the customer, the credit worthiness of the customer is not known to the application, to the person who is running the application. And now, let's say we also would have faced this thing wherein we haven't even applied anywhere, and we used to get SMSs stating that, click on this link and get this much of loan. People would wonder that, they had not filled in any application, their credit assessment has not been done. And a person, let's say with an income of, say, for example, 10,000 a month, was sanctioned a loan which was way higher than his credibility in terms of the repayment, in terms of the cash flow capability that the person has. So all this led to a cycle wherein a person was even not able to pay but was offered a loan, and that person took the loan and then later could not started defaulting. So that is why this guideline came in, specially that there should be proper document and an auditable trail that the documents have been collected from the customers to assess their credit worthiness. So if that has not been done, then that gives a clear indication that the customer has not even applied for the loan in the first instance. Then due diligence has to be done before hiring any LSP, which is any loan service provider, or any DLA, any lending app. So credibility needs to be checked whether that LSP is capable of ensuring their privacy policies, how the LSP would be storing the data, and all these things should be taken care of even before onboarding the DLA and the LSP. The loss sharing arrangements with LSP, that which is the default loss guarantee, this we will be discussing later in a separate section. The other related provisions to the digital lending guidelines can be understood in the process of disbursing and servicing. So it says that the disbursal should be directly into the bank account of the borrower. There should be no pass-through or pool account or any third party. And this also somewhere gave, we can say, it was a sort of a loophole wherein the arrangement between a bank or an NBFC and an LSP was misutilized, wherein the money would come to the repayment would come to the LSP's account, and then there were rift in terms of the NBFC or the bank would face consequences, wherein the LSP probably is withholding that amount or not giving it back to the NBFC, and specifically the entire amount, or all those instances were also observed. Then it also mentions that in case there is any amount that has to be paid by the regulated entity to the LSP, so the LSP should not charge anything from the borrower. The LSP should only act as a service provider, and any charges that have to be paid has to be paid directly by the regulated entity. The LSP should not charge anything from the borrower directly, as in the sense it should not bypass the NBFC or the lending institution. Then again, another concept that came out was the cooling period. So earlier it was there, it wasn't so prominent, but with these guidelines, it has made it very prominent that a cooling off period or a look-off period has to be given to the customer, wherein the customer can say that has an option to exit the loan whenever it wants to. And a minimum period has also been specified.
See, in what situation this will happen? Because if a customer has to repay, he can repay. But in what situation he will take this decision of just exiting like this? Because if I have taken a borrowing, I will not be exiting as such. I have to repay the money, and which otherwise I have to repay at the end of the tenure. So what's the main objective behind this option that you can exit?
So I think this probably stems from the fact that earlier, let's say, I think we all would have gone through this one particular situation wherein we had a message that, click on this link and fill an application. The moment we used to click on that link, it used to directly, since already all the information were already available to the to that party who was sending us the message, an automatic credit used to come into our accounts. And there have been instances like these wherein the customer realized that, I just clicked on one link and there is money in my account. Now I have the obligation to repay it back. This is one of the instances. There might be other instances also. So in that case, the person...
I have seen cases where you get a credit approval on clicking of these links. But I don't think at any point of time there is a disbursement in my account.
Disbursement also happens. Anil sir, maybe in case you have any insight on this, you can
Ankit, it has not been like a random thing, but the whole process has been so new to so many people. I mean, even today, when you and I click on certain links, sometimes we're not fully aware of what is going to be the next step. You go on clicking. And there has been few instances where, unknowingly people clicked or wo click karte chale gaye, and only to realize a certain disbursal has actually happened to them. So it is more of a behavioral aspect that actually happened. And they said, okay, we should pardon these people. They are not the tech savvy people who had applied for a loan. And that's why, we should give them access to move out. That's the only reason.
Okay.
And also another reason, sir, what I can understand behind this regulation is, let's say, I unknowingly, or let's say I knowingly took a loan. And then I realized after a day or after a month, let's say that I don't want it, or I have repaid it, or I can repay it quicker than the tenure that has been given to me. Now, in that case, let's say the customer is reaching out to the application, putting in requests that I want to repay it back. I don't want to bear the interest of that particular period. So for that period, let's say my loan is due on 30th of the month, and on 10th or 15th, I realize that I want to repay it back. Now that application took so much of time, since there was no mechanism of this cooling off period, that application would wait till the 30th with the intent of squeezing out the entire interest for that period. So then the customer was at at the helm of the application, that I have put the request, but I'm not getting anything in return. I'm neither getting an acknowledgement, neither getting an exit. So that is another reason that can be attributed behind this regulation, that now days have been fixed. That the loan tenure is less than 7 days, the cooling off period cannot be less than 1 day. So an application or a regulated entity cannot make the customer wait for more than a day to exit the loan. So this is another reason we can say, to safeguard the interest of the customer. When a customer wants to repay it back, let them repay it back immediately and not face the consequences of the additional interest rate and the other things that are building up till the actual date of the repayment. So that's another thing. So anything else on this part?
Okay. That's okay.
So moving on, for the disclosures, of course, there were earlier, disclosing of interest rate is one thing that was always mandated. But now with the annual percentage rate, this APR, it has been mandatory. It has been made mandatory to disclose this particular feature in the to make the borrower aware of the annualized percentage rate. So it is an all-inclusive cost and includes the margin as well. So earlier, maybe there were instances wherein a rate of interest was getting flashed in the system and the customer would click thinking that, okay, this is all. But then there were hidden charges, and as and when the person used to progress during the tenure of the loan, additional hidden charges, as we all would have faced at some point of time, that we saw 1%, but we ended up paying more. And then we had a number of questions that maine to itna soch ke liya tha, now I have to pay this. So that's another reason why it has been now mandated that all the components of the cost have to be the annualized percentage rate. The total cost has to be made aware to the customer, and what the entity is recovering from the customer cannot be more than this. In fact, it includes the late payment charges also, because there were many instances wherein the NBFCs and the banks, they would later on change their policy all of a sudden and say that, okay, now the late payment charges are exorbitant rates, and the borrower would find it difficult to repay it back. So that's why a couple of this APR has been made mandatory as a disclosure now. Another disclosure is the key fact statement. Of course, there is a proper format which has been given by RBI, and also which is there in the guidelines. It contains the basic details that every customer should be aware of in terms of what are the repayment dates, what is the rate of interest, then what is the recovery mechanism that the customer would be following. The details of the grievance redressal officer also should be there in the key fact statement, so that the customer is not led astray in the middle, that whom to reach out to in case he has any concerns. Then product information and link to the websites. These are certain critical things that have been mandatorily have to be followed under these guidelines. So product information, any application which has even at the sign up stage itself, the product features should be completely mentioned. There should be nothing hidden, or there should be nothing should be concealed behind the features that are getting displayed on the face of the app, of the product page. Then of course these DLAs and the LSPs, they have their own websites and their applications. They should also provide a link to these. They should give a link of the NBFC or the bank which is behind them, just so that the customer is aware that this is the actual borrowing entity from which I'm borrowing, and these are just the DLAs and the LSPs are just helping me, are just enablers in that process. Then of course nodal grievance redressal officer has to be appointed. The list of LSPs also have to be, let's say an NBFC has to disclose in its website of all the an LSP has to disclose in its website of all the other engagements it has with all the other entities. This is just to ensure that an NBFC or a regulated entity is able to take a informed decision that, okay, I'm onboarding this LSP. This LSP is already tied up with XYZ 10, 15, 20 other NBFCs. So it sort of gives that transparency in taking that decision whether to onboard them or not. In terms of storage, again, there are digitally signed documents have to be given. The key fact statement, sanction letter, terms and conditions, and all these things have to be added, have to be given to the borrower. Then it also says that there should be a process wherein all these documents should automatically in one click should flow to the borrower, and the borrower should not go on running behind these apps to take these signed documents. Then again, in terms of information storage and sharing, the data collection has to be need based. Unlike earlier, since data is so sensitive and there have been earlier concerns of maintaining the privacy of the data. So with these guidelines, it says that prior explicit consent should be taken when any information is being taken, is being obtained from the borrower. Unlike earlier instances, like I shared earlier, that we just click on something and the entire chain and the background happens, and we are not even aware of where our Aadhaar or PAN is going. So now a specific consent, borrower has to give the consent that okay, this is the reason for which the application has to state at every stage that this is the reason for which your information, this information is being sought. Once the customer consents to it, only then can the information be shared with the regulated entity and the app. Also, it also says that the borrower should also be given an option to delete the data from the application, which earlier wasn't there, and the data once stored could pass on to XYZ and many other entities and could get misutilized in whatever way which even the borrower was not aware of. So now it says that there should be an option given to the borrower that okay, he or she is inputting the details in one application. There should be a system that okay, delete the data after step 1, step 2, or step 3. So this flexibility and transparency should be given to the borrower. Then again, in terms of storage, a couple of other things have also been stated that DLAs and LSPs should not store personal information. Of course, where KYC and other activities have been outsourced or required operationally, there should be no additional information that should get stored with the DLA LSP for a perpetual period. Then it also says that the another aspect which it covers is reporting to the credit institutions. So many NBFCs and lending institutions and banks who are, let's say, undertaking very small ticket size loans through an application, let's say. So it also mandates that every loan that is being given, irrespective of its construct, irrespective of its tenure, amount, every loan should get reported to the credit bureaus. Then a couple of other things which are also mentioned that in terms of recovery agents which were being hired by the NBFCs and the regulated entities, they should not resort to any harassment. Then there should not be any, because these were the cases that came up specifically during the pandemic, wherein the information which was stored in one person's mobile phone, of course, let's say, that also got hacked, and the defaulter details, the details of default used to go to all the other people in that person's phone book. So to curb these practices, these guidelines were also issued. Then specific timings have been given that any agent should not call before 8 a.m. in the morning or after 7 p.m. in the evening. Then should also not make any false or misleading representations on its own. Any representation, any declaration that is coming, it should come from the regulated entity. Then this is just a summary of what all things a DLA and an LSP should do. Of course, in all the preceding slides, we read how things that a regulated entity should be doing. But when it comes to the apps specifically for entities which are which is only a DLA or which is only an LSP, so they need to have nodal grievance officer. They need to have link to the regulated entities websites. Then they should have a comprehensive privacy policy. They should disclose the policy to the customers of how the customers' data is being stored. That entire policy needs to be made aware to the customer. Then they should not store any biometric data. They should not store any personal information. And they should also, desist from accessing any mobile phone resources like file and media. Because once an app is stored, person is unaware of, it says that give permission to 1, 2, 3, 4, 3 things. So while giving the permission, while clicking on the permission, the person might be unaware of that, even the personal information stored in the phone, other applications get captured by that application. So
Debashri,
These
I
are
think,
certain things that an LSP should not do.
Debashri, I
Then,
think with the,
yeah.
am I audible?
Yes, sir.
So now I think with the advent of this personal data protection bill, I think these things also needs to be relooked. But who is under the obligation to ensure all these things? Is the LSP or the RE? Who, in
So
case there is any default,
ultimately, it is
then
the RE.
the penal provisions will trigger on the RE, or RBI can also levy fines on these DLA and LSPs. Sorry, not on the
So,
DLA. DLA though is it's an app. So on the LSP,
so these LSPs are, it says an LSP, an RE can be an LSP also. So
it can be,
having said that, an
but
RE
where it's a
can be
LSP
an
is a
LSP.
third party.
LSP is a third party, but let's say there is an NBFC. An NBFC can also, or an NBFC or a regulated entity can also act as an LSP in few cases. It is not there generally, but it can happen. But if we talk about the penal provisions, if we talk about the final onus at any day lies on the regulated entities. So these regulated entities only will be penalized. Now it will come back to, what kind of arrangement or what kind of we can say awareness these regulated entities had given to these LSPs, because everywhere it says, be it the outsourcing guidelines, be it these digital lending guidelines, everywhere it says that the final onus lies on the regulated entity. And that is precisely the reason why these entities have been with these guidelines, the RBI is telling the regulated entities that we have identified these people as LSP and DLA. You better make sure that you are making them do 1, 2, 3, 4 these things. So the ultimate onus at the end of the day lies on the regulated entities only. Then further moving on, just a couple of snapshots of what are the grievance redressal mechanisms that have been given, that are available on the RBI portal. In case anybody wants to, person who is aggrieved by is not getting response from an RE, is not getting response from a DLA, is not getting response from an LSP, they can go on to this RBI page. There are, all these have embedded links. They can click and they can easily file complaints. This is the CMS portal of RBI, wherein it is pretty much easy for anybody to just log in and file a complaint. It has the list of entities which are covered under the ombudsman scheme, which are not covered. So this has been pretty much one of the key steps taken by RBI. Now, I would rather, sir, if you suggest, Anil sir, I think is running short of time. I would request him to, take up the next, and I'll cover the FLDG after that, if that's okay.
Sure. Thank you, Devashri, and thank you, Ankit, for having me today. I know it's been like a little short span of time in which I've just, got myself in over here. I think, Ankit, you had very fairly laid down the entire context of the whole, the new era of lending, I would say, and how the regulators are looking at it. And what are the nuances, what are the issues, what are the, let's say, challenges coming out of it. I will try to speak mostly, of course, I'm a technologist, I'm a lender, I'm an investor, so all kinds of hats comes to my head. But if you basically, I think, if I have to summarize the last, I would say 10, 15 years together, and why are we talking on this today, is primarily lending was always happening. It was not that lending pehle kabhi nahi ho raha tha. It was always happening. Banks were lending, NBFCs were lending. And however, the whole modus was a much more elongated, lamba tha, right? The way I could assess you very quickly was not there. I cannot do your KYC. People used to come to our home and get it done, right? So while the traditional lending continued, I think it was only in the last 6, 7 years when I think the regulators like RBI and the ministry started, pushing the industry and say, hey, you know what, let's create some kind of a tech stack, right? Let's create what we today known as, the APIs, the open APIs, for example. कि एक बार में बंदे को you can, know who this person is and also underwrite who this person is, for example. So I think the whole lending is more like a big assembly line, right? Which had many, processes over there itself. And then as we were going further and further, each of the processes were being seen whether ये मैनुअल चल सकता है या इसमें कुछ एक डिजिटल जर्नी लगना होगा, राइट? और वो करते करते बेसिकली व्हाट हैपेंड वाज, आई थिंक इन 2015-16 when these APIs started coming up, suddenly the so-called financial companies who were still trying to do and understand क्या कर सकते हैं lending में, they got this and they say, hey, what? Now I think we can underwrite these people, a set of borrowers who, let's say, the bankers are not able to underwrite, right? So suddenly the whole new to credit kind of the market started opening up over there. And how you can do that? Because many reasons. I mean, I'll try to cover one or two over there itself. So I think while this was happening, I think the regulators are also looking at it, ki kya chal raha hai, right? I'm sure you will appreciate most of these fintech companies. I was reading somewhere that I think in the last 1 year, about $1 billion worth of funding has happened, in the fintech, so-called tech-led NBFC space. So there's always a pressure also, from investors. Here is the chunk of money and you need to move here and then you need to move there. So everybody goes back to the VC circle or the investor and say, I have a technology stack, and then there's a rosy picture given. And then you raise capital and then you start pushing because you have to do month on month, quarter to quarter. As a result, what I've seen is many places or many companies, the tech stack, so-called tech platform that these lenders or let's say who believe in, is not full grown. I have 50 examples, where they say we are a tech-led agri-tech, we are a tech-led insure-tech, we are a tech-enabled, we are first tech, and then we are this. And when you go inside, you see there are so many broken systems. Everybody is literally struggling, to catch up with. So while suddenly there had been a steep rise in terms of disbursements and giving loans, there has always been a scenario where a lot of stress started coming out to the portfolio. Now I think that is where the RBI and other regulators stepped in and said, hey, you guys seems to be going in massive state, right? There was no regulatory environment at that point except NBFC. So suddenly a fintech company says कि यार मैं lend कर सकता हूँ. मेरे पास में
Just to interrupt, I think the reason of stress is primarily because mostly were retail borrowers and these were unsecured loans.
They were retail borrowers, they were unsecured loans, and there was a pressure to get numbers. I mean, you're from the industry, so
So the disbursement,
yeah. So it was disbursement over there, right? And then what was happening? Actually, it was disbursement was at the cost of a customer's trust, customer's experience, and customer's own protection. कहीं ना कहीं पे, not we, but everybody, I think, in the industry took a task कि चलो ये तो हो जाएगा. We will see that. Now, I think when the India story was building up in the lending space, that's when the Chinese came in, right? And then they came in and they said, hey, great app, let's start do lending. They had a lot of money to put in. And then they said, oh, and the whole FLDG concept came. First loss default guarantee, 100%. We want to disburse 100 crores, we'll give you 100 crores. That kind of a concept. This was also not so well being taken by banks, or mostly I think the bigger NBFCs. So everybody got a comfort. कि अरे वाह, चलो underwriting को छोड़ो, unsecured को छोड़ो, पैसा तो है मेरे पास. And then when this started happening, the whole system got greedy, and that is where repayments fell. Recovery agents came in, and we had the sad story of 2021 December, the Hyderabad story, and that's where the skeleton started falling. And I think it was a great thing that, this was one part of it. I think the second part which was happening is the borrower was getting caught between a real lender and so-called today's LSP.
LSPs.
Right? वो बोलता है मेरा borrower है कौन? Who is my lender actually? आप हो कि ये हो?
Because while borrowing, you didn't recognize who was actually the lender. You only thought LSP is the lender.
Exactly. So I used to personally go and I used to tell my team, we used to go out doing collections, 10,000, 20,000, 50,000 rupees. And we were one of the fintech companies, right? So the borrower used to say, sir, आप कौन हो भाई? ये पैसा तो मेरे agreement में it has come from this, NBFC, for example. So who are you coming in? So I think it started exposing so many, let's say, gaps in the areas which had to be filled up. And that is why I think RBI came and said, hey, I think let's create the trust between the borrower and the regulated entity first, right? Let's make everything applicable and visible to this borrower between the RE. And the role of a fintech or so-called LSP was simply turned on to be a pure direct sales agent, or let's say a lead generation company, for example. कि आप अपना lead ले आओ, convert हो जाएगा, we will give you the money itself. So somewhere I think it brought a bit of quite a bit of a comfort. It's actually a tailwind for all the lenders today, right? Because now they know their end customers. Now there is no more malpractice. Now the data protection things are being taken care by them itself. So each of these blocks is where RBI wants that the regulated entity, please build yourself over there itself. We don't have anybody who was rushing has been shut down, right? So no leakages, nothing. So I think that is where the reason why, Devashi was talking about all these, small elements. These are all very critical elements to this. Because, I think now you're not lending to 5% or 10 people, right?
Yes.
You are not lending in one particular location. You are lending pan India. I mean, we were doing some 20, 30,000 loans a day where I had not seen my end borrowers, right? How do you create that kind of a trust to build it over there? Which means that, again, going back to your manufacturing unit, your assembly line has to be so strong. If you have 20 processes lined up, each process has to be seen from a data protection, from compliance, from trust, from user experience, and comfort altogether itself. So 20 into 7 means there are some 140 moments of truth has to all happen together, and then this has to happen. And I think that is why, though it has created an impact on few people, I mean, few things like the AI has to be tweaked or machine learning has to be tweaked. The buy now pay later as a concept का थोड़ा सा वो आगे पीछे हो रहा है कि now who's going to bring buy now pay later, for example, right? So I think these things are all coming in, but net uh, what I from as a lender point of view, I think it's a very good decision. I think the second thing which has come up now from RBI in terms of the whole FLDG model itself, right? Restricting it to a 5% and say putting all the banks and all the regulators to task, I mean the lenders to the task. Thank you, boss. Please don't believe only on that 100% and 5% over there itself. Go back and do your groundwork, which means you want to have a pie of the bottom of the pyramid, you need to then define your risk assessment much better. You have to use technology, you have to use a better credit engine to understand why. You cannot just do a trade कि 10 crore आपको देना तो 10 crore का मुझे FLDG दे दो, सिक्योरिटी दे दो, ये कर दो, फिर जो होगा देखा जाएगा. Right? So somewhere I think the regulators have made even the lenders very into it कि you cannot, it's lending. You cannot say कि नहीं मेरे को guarantee है तो मैं lend करते जाऊंगा. That's not real lending, right? The real lending is how you underwrite, collect, and then again repay or give a loan back to these people again. So I think that's my kind of a take, in this entire piece.
Okay, but
I know I'm short of time, but I can have questions.
Just few of questions. So even though you mentioned that RBI is now put lenders to do what they should be doing instead of just relying on a LSP, they should be doing what they do as a lender. But still, are they relying on the credit assessment of these LSPs to a large extent, or they have now moved on and creating their own AI-driven systems to do these credit assessment of the applicants?
So Ankit, just to quickly answer this, a couple of hours back, I was sitting with a very large, very big lender, reputed lender. And I said, sir, आपका तो अब ये 5% वाला आ गया है. And he said, and then I had another meeting with the bank. They said, it's simple. We will not lend. We will not let the whole thing. We need collaterals, we need all these things. So, the mindset, the technology, and the zest to go and create something, it will evolve over a period of time.
Definitely,
It
I
cannot just
think
happen.
it will. Yeah. I think whenever there is a regulation introduced in any industry, it has actually overgrown over a period of time.
Absolutely. Yeah.
I think this will happen in this industry too. Yeah.
Look at SBI, for example, I mean, today they are giving 1 lakh, 2 lakh, 5 lakhs just on a click. Right? We always said bank to bahut time lagata hai, ye karta, wo karta, but it's all happening over there itself, right? So there'll always be in all these, the banks, the NBFCs, which are the regulated part, there will be early adopters. There'll be some who will be pragmatic. कोई एकदम पीछे मुड़ करके देखेगा सोचेगा. So from a regulated, then we move into an unregulated. So there'll always be a tussle in between. And I think going forward, we are all dealing with the raw material here is capital. It's all money. It cannot go unregulated.
Definitely.
Right. So I think as and when now with these two things coming in, we'll see, wait and watch how it happens. The regulators are watching it. And then again, some new policies will come in. It's only to smoothen the whole process. That's my kind of a take up.
No, thank you. Thanks for your kind wisdom. And I think thanks for sharing your time. You
Pleasure.
have to attend to other preoccupations of yours. And I'll thank you again. And I hope we'll see you again in one of our future webinars on topics on NBFC finance and other things.
Sure, sir. Sure. Thank you so much for having me, Ankit.
Thank you.
For the
It's my
leadership.
pleasure to
It was a
be.
pleasure. And more than happy to take any offline questions later through either
Definitely,
your
we'll come back to you in
channel.
case there is anything.
All right. Okay.
Thank you.
Thank you
Thanks,
so
Rajat.
much then. Thanks.
Yeah.
Thank you, sir. Thank you so much.
Yeah.
Thanks. Sir.
Devashri, I think you can continue with the FLDG provisions now.
Yeah. So moving back to the presentation on the regulatory part, we had a quick, I think, industry insight from Anil sir. Now a small background of what exactly how this FLDG. I think people who are not even in this industry have been coming and asking FLDG, what is FLDG? So just a brief thing that this FLDG was in place ever since. It was just that it was not highlighted anywhere. It wasn't quantified anywhere. There was no regulation behind it. And the industry had used this 4-letter term to its maximum. It had exploited this term like anything, wherein, as Anand sir also mentioned, that any fintech would come and say, any lender would come and say that, I'll give you 100 crores, disburse this to my leads, and you have 100% guarantee on that. So that was the impact, and that was precisely this FLDG, this 4-letter term, had the impact of building thousands of fintechs that emerged in the past couple of years. Because if we see from an industry, from an NBFC perspective, then for an NBFC, there cannot be a better deal wherein somebody is coming and saying that, you take the money, I'm also giving you the people to whom you have to disburse this. And if you don't get back the money, then I'm there to guarantee that. Even to extent of 100%. It has happened in many of the cases. Because the people who are lending the money, there is no cash crunch at their end. And NBFCs who are predominantly, they're running after banks and bigger financial institutions to raise funds. For an NBFC, it was a win-win that I don't have to even walk out to collect the sources to take the leads. I'm getting the leads, I'm getting the money. In case the person defaults, my book is completely covered. My loan is completely covered. I don't even have to face the consequences in case I don't even know. And the NBFCs went into a stage wherein they said that, okay, I don't even want to know who is the borrower. I don't even want to, except for the formalities that an NBFC has to do, which of course came in with these, which have already been there in place, wherein an NBFC, and now with this key fact statement and APR and disclosures of these things, now it is in fact wanting, the RBI is warning the NBFCs and the banks to, move to the market, go to the ground level and see who your borrower is. Because with, let's say I am getting the money, I am getting the leads, I have no koi tension hi nahi hai ki paisa wapas aayega ki nahi. So in that case, somewhere that connect between the lender and a borrower was fading away. So when these digital lending guidelines came in, when the recommendation first came in the month of January 21, from then the working committee which was formed to give a report on this entire digital lending thing, they came up with this deal-breaking sort of a recommendation that FLDG should completely stop, was their one recommendation. And they also said that even if it happens, there should be a particular limit to it. And the reason behind this was somewhere the industry took it in a way that it is wanting to curb the growth of the fintechs. But that being said, that was of course the regulatory part. But the RBI's intention as a regulator was to make sure that an NBFC is aware of who it is lending to, and it should take the risk at its own end. and it should not rely on anybody external. Because let's say today an NBFC is getting 100 crore of credit line. It is 100% backed by the FLDG. I have thousands or let's say a lakh of not potential, in fact, completely credit analyzed borrowers to whom I have to send this. I have to give this money. Now, somewhere the risk or the asset which is there in the book, which is sitting in the book of the NBFC in a way has no control over it, because the money is flowing from somebody else. It is going to somebody who the NBFC has not onboarded on its own, but has got this lead from somewhere else. And in case it is defaulting, then the NBFC is least concerned, because book में पीछे से FLDG revoke हो जाएगा, the money will come in and the book is clean. So with this setup, the regulator's intention was to make the NBFC take the heat, or rather, be more responsible in terms of to whom it is lending. And when these guidelines came in, when the digital lending guideline came in the month of September last year, there was just one line which created a havoc in the entire industry. And that one line was loss sharing arrangements in case of default. This was the heading. And the first line it said was, REs shall adhere to rules of synthetic securitization. So somewhere what it did was, any sort of guarantee arrangement, any sort of arrangement wherein the loss is being shared, RBI simply said that the rules of securitization will have to be followed. Now, what was synthetic securitization? Synthetic securitization means, by definition, a structure where credit risk of an underlying pool of exposure is transferred in whole or in part through the use of credit derivatives or credit guarantees that serve to hedge the credit risk of the portfolio, which remains in the balance sheet of the lender. So as we all know, there are securitization rules are a set of different rules altogether, which have been there in place for quite some time. And earlier, that was the only recognized way of obtaining guarantees and providing getting guarantee, or rather a coverage behind the loan. But this FLDG was exploited to such an extent that somewhere it was bypassing, it was somewhere overshadowing the rules of the securitization which are already in place, which are of course more stringent, and there are steps, there are laws and rules and regulations at every step of how much can be done, who are the parties involved, what are the agreements. There are agreements and there are third parties involved at every stage. So with this one statement, the entire FLDG was completely, we can say, got banned in the entire industry. And I think it would be prudent to mention that a lot of NBFCs, a lot of fintechs, which were thriving on just this one model, NBFCs particularly, they were overnight shut down करने की situation आ गई थी, because they knew that now that it has been barred, it cannot, the basis of its existence is gone. The money won't flow in, the money won't go out, and default to baad mein. That third step, there is a barrier that has been put at the third step. So the first two steps obviously won't happen. So after much deliberations, there were a lot of industry representations that went, a lot of fintechs, a lot of NBFCs even stated. There were many SROs who made representations to RBI stating that, allow it, but give it some, shape and substance in terms of guidelines. Because this was predominantly, we can say, the bread and butter of the NBFC in terms of, as I mentioned, that sitting without doing anything and just building the books. So that was the reason why when this prohibition came, the entire industry was in soup. And after a lot of deliberations, finally in June this year, the formal guidelines came out, which was a much needed relief for the entire industry per se. Not just for one segment, but rather the most, fintech, as we say, is the most fast emerging space or part of the economy. And something had to be there. It could not happen that just because of this one guideline, the entire industry would, predominantly vanish overnight. So when these guidelines came, lot of clarity. It came in with a lot of regulations, clarity, and of course, as sir also earlier mentioned, the capping of 5% was there. Now, before we go deeper into the regulations, what exactly is an FLDG? If we try to understand it in a very simple way. So FLDG is nothing but just an arrangement between a regulated entity, which is an NBFC or a bank, with the LSP, or any other regulated entity with which it has entered into outsourcing arrangement. So as we have been discussing, predominantly what the industry practice was an NBFC getting into an arrangement with an LSP, or let's say, which is predominantly a fintech. An LSP can be understood as a fintech. So the fintech would enter into an arrangement with the NBFC, say that, okay, this is the amount that I'm giving you. These are the number of people with the complete list of all the borrowers. You have to source. I have sourced them, and since I have sourced them, I am taking guarantee of these people that in case they default, I will cover it up to 10%, 20%, 50%, even to the extent of 100%. I'll cover it up. Now, the regulations which have come in, it says that an RE, which is an NBFC, can enter into an FLDG arrangement only with an LSP or with any other regulated entity. Now, all other entities earlier, of course, it was not the practice, but there were entities which were not even, let's say, a trust or any society form or any other form for that matter. Even they at times used to try to get into such arrangements, and it was not barred anywhere. But now, with these guidelines in place, it has specifically said that only companies can do this, which are registered under the Companies Act, and more so, it can only be an LSP and an RE. So it has somewhere made boundaries in terms of how to identify. Like for a regulator, if a regulator is saying wants to know that an NBFC is taking credit from whom, it is taking the resources, it is taking the leads from whom. So now a definitive answer to that is it is taking from an LSP with which it already has an agreement. So this would mean that for an FLDG arrangement to happen, there should be an existing agreement, which means that the NBFC should have some history, some background that, okay, this LSP is giving me the leads. I already have an arrangement with him, with this person, with this entity, sorry. And somewhere the credibility is established at the stage itself, which we will take up in the further slides, that there have been even guidelines which have come in which say that you need to have board approved policies to onboard the LSP. You need to have specific you need to have proper due diligence of before onboarding an LSP. So that is one major thing when it comes to understanding of an FLDG arrangement can be entered between which all parties. Now, once an agreement is entered, what is an FLDG? It guarantees to compensate for loss due to default up to certain percentage of that portfolio, right? Now, what exactly is this percentage? If we talk about the percentage, as already mentioned earlier, is 5%. So earlier there was no limit. It even used to go up to 100%. But now with this 5%, it has we can say, it is telling the NBFCs to be diligent in giving the loans. It cannot happen that you have made your credit appraisal process, you have made your APIs, you have managed, arranged your APIs and other things and appraisal process in such a way that even a person who has, let's say, defaulted last 2 or 3 loans, you are giving loan to that person. So this in a way will what happened in the US many years ago. A person who was not even having the capability to pay went on taking loans, and then ultimately it went into a loop and there was a complete crash in the market. To avoid that situation, a particular limit has been set, and the purpose behind setting this limit is nothing but to make the NBFCs diligent in making their credit assessment process. I mean, they cannot say that, okay, the regulator said that, okay, I'm allowing the FLDG, but you can cover only 5% of your risk. Now, if we try to understand whether this 5% is applicable on which kind of arrangements. So one arrangement is, if you look at the right side of the diagram, the FLDG, by the definition which the RBI has come up with, it says that it has to be on a loan portfolio. A loan portfolio has to be a complete one. So it cannot say an FLDG arrangement cannot happen in a way that a lender will say, let's say an LSP comes and says that, okay, this is the pool, these are my 100 customers, and from that, these are 10 or 20 odd customers to whom I am for the loan, for which I'm providing guarantee. Such kind of arrangement cannot be an FLDG. For an FLDG to be in place, to be classified as an FLDG, it has to be on the entire portfolio. So with this example, let's say this is on the left hand side, let's say there is a portfolio, there's an NBFC which has borrowers who have this much amount of loan. Let's say a borrower has 14 lakh, has availed a loan of 14 lakh. Another borrower has availed a loan of 10 lakh, 6 lakh, 2 lakh, 20 lakh. Now an LSP comes and says that, okay, this 14 lakh ka, I will take 5%. I'll guarantee 5%. This 10 lakh wale loans ka, let's say there are number of products beneath these particular different ticket size loans, says that, okay, I'll guarantee these 10 lakh loans from this range to this range, I'll guarantee this much. I'll guarantee 10%, or say even lesser or even higher. So the first stance of an FLDG to be in place is that it has to be on the whole agreement. It has to be on the whole portfolio. It cannot be selective. If it is selective, then it is not an FLDG. Simple. That is one thing. Then moving on, what kind of guarantees are covered? So what is covered is, of course, the term we have been discussing is first loss default guarantee, but the guidelines cover even second loss default guarantee, third loss. It can be to any mezzanine and any further stages. But the reason why we don't further stress on second loss or the third loss default guarantee is, once if a loan is already being covered in the first loss, the person having second loss guarantee will generally not enter into such agreement unless there is any huge benefit out of that. A person who has generated the loans is taking the first hit, and that is enough. Now, in fact, these guidelines, there is no restriction, which means that it can even apply to all the further layers of guarantees that a particular product, that a particular portfolio can get. Then further it says, as per the definition, even implicit guarantees are covered. So implicit guarantees are nothing. It says, so stating this particular term means that explicit guarantees are by default covered, even implicit guarantees are covered. So implicit guarantees, it has made specific so that the NBFC should not bypass the rule and say that, okay, since usme guidelines mein explicit hai, so I've made an agreement of 5% explicit, and then implicit I've made some of the other XYZ arrangements, and in a way 5% to mera explicit mein cover ho raha hai, and the rest of it is getting covered in a separate arrangement or an agreement. So just to stop that thing from happening and to bring the entire guarantee under the ambit of that 5%, the RBI said that even implicit guarantees are covered in the FLDG. Implicit guarantees and explicit guarantees together, they will form the threshold has to be calculated considering both the types of guarantees, which is 5%. Now, things that are not covered, guarantees that are not covered under the co-lending and under these FLDG guidelines particularly, one is the co-lending arrangement, which we can say it is not specifically written anywhere, but simply if we go by the understanding that FLDG is entered between an NBFC and an LSP, with which it has some outsourcing arrangement. And what is outsourcing arrangement? An outsourcing arrangement is an activity which it is doing on behalf of the lender. Now, if we talk about co-lending arrangements, and co-lending, both are lenders. We cannot say that, let's say, a bank and an NBFC are in a co-lending arrangement. We cannot say that the bank or the NBFC, for that matter, is doing the activity which the bank should do. Both of them have their own set of responsibilities in a co-lending arrangement. That is the only premise, that is the only reason by which it can be understood, it can be inferred that a co-lending arrangement is not covered under the ambit of the FLDG, because here there is no LSP, both of them are lenders. Another instance that we can think of is when it comes to top-up loan. Let's say a credit line of 100 crores has been identified, or let's say 50 crores for that matter. Now 5% has to be is defined on that 50 crore, or let's say on that 100 crore. Now, let's say the outstanding, there are no defaults, and the person, the loans and the leads turn out good, and there are very less default, less than 5%. There is, let's say, 2% default. Now the 3% gap is left. Now the lender, the LSP, comes and says that, okay, I'll give you further money and you can utilize the rest of the 3%. So if that had been allowed, then there would have been an ever going chain of, of that top up and that guarantee. So just to avoid that and to bring and to ensure that, and this is the purpose behind this, is just to again identify what arrangement is there, because one agreement will have only one amount and 1%. Of course, it can get changed, but it cannot add on. I mean, if the provision would have been given to, have it in a circular, as in on a rotating basis, that, A sites outstanding is reducing and that guarantee is increasing. So that would have led to a ripple effect, and it would have been difficult as a regulator to identify at a later stage, even for the NBFC also, that which loan is covered, which loan is not covered, how to invoke, when to invoke, first tranche mein invoke karna hai, second tranche mein invoke karna hai. So just to avoid all that, the simple thing has been stated on the loan outstanding, which means at the time of the sanction amount and not on the outstanding amount. Then another thing that we can understand is corporate guarantees are not covered in this. Of course, we'll study further that how an FLDG can be given. An FLDG can be in the form of a bank guarantee. It is not written corporate guarantees, and corporate guarantees, as we understand in the practical scenario, they are given within the group to related parties, to companies within the same group, without at times even taking any security in return. So if there is no security in return, then the very purpose of the FLDG won't serve the purpose, would get collapsed. So that is why corporate guarantees are not written anywhere, and we can understand that it is not covered under the FLDG guidelines. That is, in case a company is given a corporate guarantee, then it will not be required to follow these guidelines for FLDG. Then moving further, the guidelines also says that there are certain key things that should go into an agreement. Of course, having an agreement is the first and predominant thing that it has specified, that an agreement has to be in place before, to identify an FLDG arrangement. So extent is it has to be 5% of the loan amount, as we just discussed. The form of an FLDG, it can be either a cash deposit, it can be either a fixed deposit with a scheduled commercial bank, or it can be a bank guarantee. So it comes out the absence, the non-coverage of corporate guarantees somewhere stems out from this definition, that since bank guarantee is always backed by certain assets, fixed deposit is demarked, cash deposit, of course, comes with its own caveats and this thing. Since corporate guarantee has the potential of not having any security in the back end, that is why we can say that it is not covered in the FLDG. Then it also says that there is a timeline of invocation that it has given. It says maximum within 120 days of the overdue, it has to be revoked. So it somewhere sets a we can say a time frame to the arrangement, because in the industry practically it happens that an agreement is entered and the loan is in default, and it is going on in the default, and loans are closed, books are closed, and still the loan is in default, and the NBFC is in a soup of whether to invoke the FLDG, whether to show it, how to show it in the books, whether to share at the end of the financials, whether to say that okay, these loans are good or bad. So just to avoid that and to give a time frame to this arrangement, it has said that within a maximum period of 120 days, it has to invoke the FLDG, and then of course make the appropriate further accounting entries accordingly. Another key aspect of the agreement is the disclosure part. So it says that the LSP, which is providing the guarantee, it has to publish on its websites the total number of portfolios and the amount offered as guarantee. So let's say I'm a fintech. A fintech is an LSP, and that same fintech is going to an NBFC and saying that these are the leads that I have. This is the amount of credit line that we can agree with. Now that for that NBFC, this has been shared earlier, discussed earlier as well. So that NBFC needs to have a transparent approach to know that okay, this LSP is coming to me. Let me just have a understanding of how many LSPs how many existing tie-ups does this LSP have. So it has also, of course, this is somewhere giving that privilege or that transparency to that NBFC. But in a way, it is not so required, but still it has been published in the guidelines, because the LSP, when it is coming to a particular NBFC or a particular bank it is coming with its own set of it is coming with its own set of credit line. It is coming with its own set of what do we call a certain percentage based on the risk perception that LSP has for the NBFC. So it is a two-way thing. If an NBFC is asking for an FLDG, even the LSP will ensure that, will see that these are the potential leads that I'm giving. Now this lead has the potential of defaulting to this percentage, and the NBFC has this much of appetite to share the risk, to take the risk, or to bear the default. Accordingly, the arrangement is entered into. So now it says that categorically it has said that LSP has to publish on its website of all the existing arrangement it has, just to have that transparency. And also in a way for the NBFCs to say that let's say an NBFC will know that okay, I have a competitor. Now my LSP with whom I am entering into an FLDG, that LSP has a tie with say my competitors. So it will give a fair level playing field to the NBFCs also to understand that and it will further trigger things like data protection. And NBFC may even stop the LSP, may even stop getting into an arrangement thinking that okay, this LSP has tie-ups with two of my closest rivals, so there is a chance of data breach, there is a chance of sharing information, there is a chance of the borrowers having that conflict. So this gives a better understanding to the NBFC also. A couple of things before a DLG arrangement is entered into. So in that we can say that certain things that have to be ensured have to be done by the NBFC before an FLDG arrangement is entered into. Not just FLDG, any default loss guarantee. It can be second loss, third loss, any further it can cover. So the first thing, as per the guidelines, it says that proper due diligence has to be conducted by the DLG provider. And this due diligence would be nothing but just to ensure that that LSP is capable of I can say honoring the guarantees which might arise in the due course of the agreement. Then it also says that the NBFC has to put in place a board approved policy. Board approved policy will define the eligibility of the DLG provider. It will also define the process to monitor and review the arrangement. It should not happen that once an arrangement is entered, then there is no checks and balance. So there should be a check and balance at every step of, let's say thresholds can be made of say if the maximum limit of risk coverage is 5%, then let's say the agreement can include a clause to say that when 1% is breached, then these are the additional checks that the DLG, that the LSP would, these are additional data points or these are additional reports that an LSP would ask from the regulated entity, from the NBFC. Then further, and the NBFC wants to invoke the FLDG further, then the LSP can say that, okay, give me reports as to why and how it has reached to such a percentage. So things like these, there should be a regular monitoring and a regular review mechanism that should be there in place. Then it also says that it should not act as a substitute for credit appraisal requirements. As this was shared earlier also, that an NBFC generally had this tendency of just sitting back and saying that, okay, my loan is completely covered. I don't even need to know whether how capable or how much credit worthy my borrower is. So it somewhere says, and again going back to what we were discussing earlier, that the intent is to make the NBFCs aware and be responsible for their own risk for the loan that is going in their books. So it also says that it should not act as a substitute for credit appraisal requirements. The credit appraisal, that mechanism that an NBFC has, of course, with the FLDG, it can slightly expand the bucket of who it can lend, but it should not be a substitute that, okay, I'm not, let this potential lead not even go through my credit appraisal process. So this sort of arrangement has been specifically banned by RBI, and it says that credit appraisal should be there and those loans should pass through the credit appraisal check of that NBFC. So somewhere with the intent that an NBFC should at the end of the day take the final call, even if it is getting thousands or lakhs of leads from any from any LSP. The ultimate decision whether to lend or not should be based on the capacity of the NBFC and not based on the DLG, on the guarantee that it is coming with. Of course, it is getting a guarantee, it is getting a small buffer, but the final decision, the NBFC should have the capability of absorbing the entire loan. That is the intent. Then
I
it
think this
also
answers, Devashri, one of the, there is a question which the participants have raised. Can an RE rely on the customer due diligence of LSP for onboarding a customer?
It can rely to a certain extent, but again, it says that the intent of putting this in a regulation, of course, this has been an industry practice that an LSP used to say that, okay, I have even done your credit appraisal, and these are the leads that have passed my credit appraisal. Now, that this LSP has completely done this. It can do, but the basis of that assessment should be in line with the risk capability of the NBFC, of the RE, is what the intent behind this is. So moving forward, another thing that it has mentioned is obtaining a declaration from
There appears to be some technical issue with Debashi's system. She's joining back. Yes, Debashi, you can. Yeah, I think, is there anything else in your presentation? We can take some questions.
Yeah, presentation.
No, is there anything else in the presentation?
Sorry for this.
Debashri, am I audible to you?
In between.
Debashri, am I audible?
I'm not exactly audible, so 1 second. Am I audible now?
You are. Am I?
I cannot hear you.
Yeah.
Yeah.
Debashri, can you hear me?
Yes,
Hello.
I can. I'm just flashing the screen. Yeah, am I audible?
You are.
Is my screen visible?
Can you put it on slideshow?
Yep.
Is there more slides to the presentation? Debashri, are there more slides to your presentation? You're not audible. Hello.
Am I audible?
You are.
Okay,
I
okay.
was
Okay.
checking with you. Are there any more slides to the presentation?
No, we just have one more. This being the things that have to be done before, and then we just
Okay,
have one more slide.
Okay, because I have
Which
received some
says
questions. I'll just put that to you.
okay. So maybe I'll quickly just run through these slides.
Yeah,
Or,
please.
so maybe you can, yeah. So it says that there are certain declarations, and an RE should obtain a declaration in the form of a certificate which is certified by the statutory auditor, and that certificate will mention the existing arrangements that the LSP has already entered into, and it will also contain the total portfolios that LSP has given guarantee to other entities also, and the past default rates that it has on similar products. So these are a couple of things as per the guidelines, which says that the RE has to ensure before entering into such an arrangement. Then a couple of the last slide is the things that have to be done after the arrangement is entered into. So it talks about regulatory capital. So as we know that NBFCs, and they have to maintain some capital, with regard to the exposure that they have. So the calculation of those capital will be as per the extant norms, the existing norms. NPA recognition, it says, has to be done as per the existing norms. And one of the also earlier, if I can recollect, it was discussed in one of the slides earlier, that in case there is any, the intent behind this, another reason why this FLDG was, the working committee said that it should not happen, was that the guarantee which was coming back to the regulator, to the RE, it was being set off from the loan, and the NBFCs had the privilege to show clean books. So somewhere that was one of the primary, another reason of why the regulations came in, that it was difficult for the regulator to identify who is the actual defaulter, and such the same data, the similar data used to go to the credit bureaus, and the credit bureaus also found it difficult to provide proper assessment of the credit, proper credit, credit worth of a borrower. Because if, let's say, a borrower, a loan is FLDG backed, the FLDG has been invoked, and that complete amount, let's say that 5% default, that 5% is being covered, or let's say there was a cover of 10% earlier, that entire 10% is being covered. Now the book will show that the amount has come and it is completely clean, and that same record used to go to the credit bureaus also. So from a lender perspective, I am getting an image that a creditor, although he had defaulted in some other entity, since that loan was backed by a guarantee, that is why that loan is showing clean, as in the borrower is clean. It is showing that the borrower has repaid all the loans on time. So that was another reason why it says that NPA recognition, it should not impact on the NPA recognition. The NPA, whether it is an NPA or it is falling in which category, it should be as per the actual status of the loan, actual repayment capacity, and not based on the guarantee that it is having. Then another, it says that it should ensure robust credit underwriting standards irrespective of the DLG cover, which we discussed earlier in detail. That irrespective of the cover or the guarantee that a loan carries, the underwriting standards, the capacity, that the reason that, okay, an NBFC is giving loan to a particular, it should be based upon the risk that it can take on its own, and not completely dependent on the DLG cover it has and the guarantee that a loan has in the background. Then there are also disclosures, as stated earlier, that the LSP has to disclose on its website the existing arrangements that it has with the other entities. Then further, this is all about FLDG. Just a quick small slide on the digital personal data protection bill that we all know has been passed in the Lok Sabha in the last week. So we will share about this in detail later in terms of what all impact it has on all the stakeholders. But as of now, just a brief of what this bill talks about and what all parties are covered in this. So it defines rights and duties of data principles. So various parties have been identified, and the basis of this data protection bill is just to strike a balance between the person whose data is in question and the party who has to utilize that data. So it cannot be skewed towards one end. The bill cannot be formed in a way that it protects the data of the borrower or the person whose data is in question, and to such an extent that operational part of it, that the entity which is utilizing that data to do some particular workings on it, or to make credit assessment, or to do any other thing. So there should be a balance between data that is protected and the activity for which that data was given in the first place. So this protection bill defines data principles, that is the people to whom the data relates to. Then it also talks about the data fiduciaries. Data fiduciaries are the people, are the companies and the government entities who are processing the data. And this data is being used for which all things like collection, storage, and any other operation on the personal data. Then it also talks about the financial penalties that can be imposed when there is a breach of rights and duties and the obligations. Also, this bill talks about appointment of data auditor and conducting periodic data protection impact assessment by data fiduciaries. So this is nothing but just to strike that balance, as I mentioned earlier, to ensure that the data is being utilized. There should not be any restriction on utilization of the data, the very purpose for which it was taken. Then also it also talks about that the personal data breach has to be intimated to the data principal. So now there is no law which says that the data, any breach has occurred and it should come back to the person. Now what happens is the person whose data has leaked is at the helm of the regulators. That person keeps on running behind RTI, ombudsman, going to RBI site. But now with this bill, it says that the person who has been aggrieved, there is a mechanism wherein the person will be intimated that your data has leaked and these are the further grievances, further steps that you can take. So that was all from my end.
Thank you, Debashri, speaking for covering such a lengthy presentation and covering detail. I have some few questions which I have received earlier. So you talked about the portfolio. So I think one thing is clear: you cannot guarantee the entire portfolio, or you have to. We cannot guarantee. Okay.
And guarantee as in terms of percentage, we can guarantee a particular portfolio, but it can be guaranteed only up to 5%.
Okay.
And it cannot be a loan-to-loan guarantee. I mean, it cannot be selective. It cannot be selective that I am guaranteeing only these XYZ people. It cannot be selective. It has to be in whole, and that quantum can be 5%.
Okay. And so these are when you enter into such an arrangement with the DLSP service provider, is it similar to co-lending arrangements?
The co-lending is different, we can say, because in co-lending both are lenders and they have their own, and in co-lending arrangements there are certain thresholds also which says that an NBFC has to keep this much percentage on its own books. So the risk sharing is also there, whereas in LSP and in FLDG the risk sharing is only to the extent of 5% of the cover that we discussed. And in an co-lending model it is different. I mean, both are lenders. Here lender is only one, and LSP is just facilitating the NBFC or the regulated entity.
And how soon this APR needs to be revised? There is one question.
Sir, APR generally it contains the rate of interest and all the key terms which is given at the starting of the loan. In case there is any loan wherein the interest rate is fluctuating or changing, let's say on any loan which is having floating rate of interest, for example, then in that case, when the rate changes, then that revised APR has to be given with the changed amount and other charges, if any, has been changed with that.
Okay, thank you. These were the questions that we received. There was one question online which you've answered. I think there is a question on how we can lower the cost on account of FLDG.
Lower the cost as in
How to cover
reduce
the
the
increase
5%?
of how to cover the increase of borrower cost when FLDG be implemented.
For a borrower, I think it all. So maybe if I talk about this FLDG arrangement, somewhere the fee. See, this arrangement comes with a fee. If when the LSP is saying that I am guaranteeing this much, it is taking something in return. So somewhere, of course, it is very much minimal as compared to the guarantee it is providing. But somewhere that balance has to be done as per the risk appetite, or rather the cash availability with the NBFC. It can it can increase the fee of the LSP, it can lower the fee of the LSP. That is the only one component which will have impact on the borrower ultimately. If that answers the question.
Thank you then. Thanks, Debashri, for such a detailed presentation. And thanks, Anil, also for joining in. Thank you everyone for joining in for today's webinar. Our next webinar is on another important topic of reclassification of promoters and the practical issues connected with it. As per the LODR regulations, there are a lot of issues with respect to when their relationship are estranged, or in cases where there is no involvement of the relatives or some promoters in the business, and there is an intent to reclassify. So we'll discuss all those and deliberate in our next webinar, that is on next week, reclassification of promoters, the practical issues involved. Till then, enjoy the weekend, and wish you all a very happy Independence Day from everyone at Corporate Professionals.